Assalamualaikum warahmatullahi wabarakatuh. Thank you for the opportunity. My name is Diana Ardika Humaida. My student number is 053.
Assalamualaikum warahmatullahi wabarakatuh. Thank you for the opportunity. My name is Nabila Mirza Nur Aisyah and my last name 100.
Okay, thank you for the time given for me. Now I want to introduce myself. My full name is Maria Luciana. My student number in 118.
Assalamualaikum warahmatullahi wabarakatuh. My name is Dia Puspita Wardani. My study last number 190.
Assalamualaikum warahmatullahi wabarakatuh. Good morning, my friend. Let me introduce myself. My name is Arfan Prananta Panca. My number is 052. Here I will explain about the step, the revisited. Step 1 is identifying the contract with a customer. The new revenue guidance defines a contract as an agreement between two or more parties that creates and for create right and obligation. Standard setter identified the attributes below as essential part of a contract. Number 1 is all parties have approved the agreement. This criterion address the fact that a contract is usually only enforceable once all parties have approved it. Number 2 is all parties are committed to fulfilling their obligation. Is termination clause must be evaluated when addressing this criterion. Number 3 is each party's rights are identifiable. The arrangement must clearly identify the good or service to be provided. Number 4 is payment terms and identified as long as there is an enforceable right to receive payment in exchange for goods or service. Number 5 is the contract has commercial substance. A contract only exists if the risk, timing, or amount of its flows on entity are expected to change as a direct result of the contract. And the last is collectibility is probable. The new standard requires vendors to evaluate customer credit risk at contract inspection. Okay, now step 2, identify the performance obligation in the contract. A performance obligation is a promise to transfer goods or service to a customer. The step requires an entity to identify all distinct performance obligation in an arrangement. A good or service is distinct when 1. The customer can benefit from the good. 2. The good or service can be transferred independent of other performance. The following issues may affect an entity's evaluation of performance obligation. Number 1 is principal vs agent, gross vs net. When other parties are involved in providing good or service to an entity's customer, the entities must determine whether its performance obligation is to provide the goods or service itself, or to arrange for the other party to provide the good or service, or the agent. 2 is warranties. Warranties, the new standard distinguish two different types of warranties, which are accounted for different. 1 is assurance type warranty. 2 is service type warranty. Number 3, customer option for additional goods or service. Many contracts provide the customer with option for additional goods or service, such as discounted contract renewals or customer loyalty points. Number 4 is non-refundable upfront fees. Non-variable upfront fees can result in a distinct performance obligation in the same way as customer option. For example, health clubs might charge an upfront membership fee when a customer signs it up, and then not require the fee when the customer renews the 1-year contract. Number 5 is stand ready obligation. Some entities may, through contract specification or through customer business practice, have an obligation to stand ready to provide goods or service to a customer. And the last is right of return. And the next is step 3, determine the transaction price. An entity excludes any future option for a contract from consideration when determining the transaction price. The entity also excludes amount third party will eventually collect, such as sales tax, when determining the transaction price. The transaction price is easy to determine when a fixed amount of cash is received simultaneously with the transferred goods or service. Other situations require more judgment, such as the situation listed below. Number 1 is variable consideration. Number 2 is significant financing component. Number 3 is non-cash consideration. Number 4 is consideration paid or payable to a customer. And the last is non-fundable upfront fees. For the step 4, will be explained with my friend. That's all for me. Thanks for the nice attention. Thank you.
And now I will presentation step 4 and step 5 about extend example of the 5-step process BIN. And step 4, allocating the transaction price to spirit performance obligation. For revenue arrangements with multiple performance obligation, BIN might be required to allocate the transaction price to more than one performance obligation in the contract. If an allocation is needed, the transaction price is allocated to the various performance obligation based on their relative standalone selling price. If this information is not available, companies should use their best estimate of what the good or service might sell for as a standalone item. And next, the example, BIN wants to provide even more incentive for customers to buy its coffee beans as well as purchase a cup of coffee. BIN therefore offers customers a $2 discount on the purchase of a large cup of coffee when they buy a bag of its premium motor mocha beans, or which normally sell for $12. At the same time, Tyler decided this offer is too good to pass up and buys a bag of motor mocha beans for $12 and a large cup of coffee for $1. As indicated earlier, a large cup of coffee normally retails for $3 at BIN. And the question, how much revenue should BIN recognize on the purchase of these two items? And step 1, in our previous situation, valid contracts have excites. The same is also true for the sale of a bag of motor mocha beans and the large cup of coffee. And step 2, the bag of motor mocha beans and the large cup of coffee are distinct from one another and are not highly dependent on or highly interrelated with the other. BIN can sell a bag of the motor mocha beans and a large cup of coffee separately. Furthermore, Tyler benefits partly from both the large cup of coffee and the motor mocha coffee beans. And step 3, BIN's transaction price is $13 or $12 for the bag of motor mocha beans and $1 for the large cup of coffee. And next, step 4, BIN allocates the transaction price of the two performance obligations based on their relative standalone selling price. The standalone selling price of a bag of motor mocha beans is $12 and the large cup of coffee is $3. The allocation of the transaction price of $13 is as follows, and the product motor mocha beans 1 bag standalone selling price $12 and percentage from 80% times $12 divided by $15 and allocated amount $10 times 40 times $13 times 18%, and the product large cup of coffee standalone selling price is 3 percentage from 20% times $3 divided by $15 and allocated amount is 2.60 times $13 times 20%, and the total standalone selling price is $15 and the percentage is 100% and allocated amount is $13. As indicated, the total transaction price is $13, is allocated $10.14 to the bag of motor mocha beans and $2.60 to the large cup of coffee. And the step 5, beans has satisfied both performance obligation as control of the bag of motor mocha beans and the large cup of coffee has passed to Tyler. And the solution, beans should recognize revenue of $13 comprised of revenue from the sale of the motor mocha beans at $10.40 and the sale of the large of cup of coffee at $2.60. And the last, about step 5, recognizing revenue when or as each performance obligation is satisfied. As indicated in the example presented, beans satisfied its performance obligations when Tyler obtained control of the products. Change in control is the deciding factor in determining when a performance obligation is satisfied. A consumer controls the product or service when the customer has the ability to direct the use of and obtain substantially all the remaining benefits from the product. Control also includes Tyler's ability to prevent other companies from directing the use of or receiving benefits from the coffee or coffee beans. As discussed earlier, the indicators that Tyler has obtained control are as follows. 1. Bean has the right to payment for the coffee. 2. Bean has transferred legal title to the coffee. And 3. Bean has transferred physical possession of the coffee. And 4. Tyler has significant risks and rewards of ownership. And the last, Tyler has accepted the asset.
Today, I will discuss the material accounting for revenue recognition issue. Sales return and allowance are very common for many companies that sell goods to customers. For example, assume that Favco Solar sells solar panels to customers on account. Favco grants customers the right of return for these panels for various reasons. A. Dissatisfaction with the product, and to retrieve any combination of the following. The 1. A full or partial refund of any consideration paid. The 2. A credit that can be applied against amounts owed or that will be owed to the seller. And the 3. Another product in exchange. To account for this sales return and allowance. FAFCO should recognize the following: the A. Revenue for the transferred solar panels in the amount of consideration to which FAFCO is reasonably assured to be entitled, or considering the product to be returned or allowance granted. And last B, an asset or an corresponding adjustment to cost of goods sold for the goods expected to be returned from customer. Credit sale with return and allowance. Assume that on January 12, 2019, Vanden and V sells 100 cameras for €100 each on account to Amaya SA. Vanden allows Amaya to return any unsold camera within 45 days of purchase. For example, on January 24, Amaya returned 2 of the cameras because they were the wrong color. On January 31, Vanden prepares financial statement and determines that it is likely that only 1 more camera will be returned. Vanden makes the following entries related to this transaction: to record the sale of the cameras and related cost of goods sold on January 12, 2019. Account receivable in credit 10,000, sales revenue 100, at times €100, 10,000 in debit. Cost of goods sold in credit 6,000 and inventory 100, at times €60, 6,000 in debit. To record the return of the 2 cameras on January 24 and 2019. Sales return and allowance 200 in credit and account receivable 200 in debit. Return inventory 120 in credit and cost of goods sold 120 in the debit. On January 31, 2019, Vanden prepares financial statement. As indicated earlier, Vanden original estimate that the most likely outcome was that 3 cameras would be returned. Vanden believes the original estimate is correct and makes the following adjusting entries to account for expected returns at January 31, 2019. To record expected sales return on January 31, 2000. To record expected sales return on January 31, 2019. Sales return and allowance 100 in credit and allowance for sales return and allowance 100 in debit. To record the expected return of the 1 camera and related reduction in cost of goods sold, estimate inventory return in credit 60 and cost of goods sold in debit 60. For the month of January, Vanden's income statement reports the information presented in illustration. Sales revenue €10,000, less sales return and allowance 300, net sales 9,700, Cost of goods sold 5,820, and last gross profit 3,880. Account receivable 9,800, less allowance for sales, return and allowance 100. Account receivable or net 9,700, and last return inventory or including estimate 180. Cash sales with return and allowance. Assume now that vendor sold the cameras to Amaya for cash instead of on account. In this situation, vendor makes the following entries related to this transaction: to record the sale of the cameras and related cost of goods sold on January 12, 2019. Cash in credit 10,000, sales revenue in debit 10,000, cost of goods sold in credit 6,000, and last inventory in debit 6,000. Assuming that vendor did not buy cash at the time of the return of the two cameras to Amaya on January 24, 2019, the entries to record the return of the two cameras and related cost of goods sold are as follows: to record the return of two cameras on for cash instead of on account. In this situation, vendor makes the following entries related to this transaction: to record the sale of the cameras and related cost of goods sold on January 12, 2019. Cash in credit 10,000, sales revenue in debit 10,000, cost of goods sold in credit 6,000, and last inventory in debit 6,000. Assuming that vendor did not buy cash at the time of the return of the two cameras to Amaya on January 24, 2019, the entries to record the return of the two cameras and related cost of goods sold are as follows: to record the return of two cameras on January 24, 2019. Sales return and allowance 2,000 in credit, account payable 2,000 in debit, return inventory 1,020 in credit, and cost of goods sold 120 in debit. On January 31, 2019, vendor prepares financial statement as indicated earlier. Vendor estimate that the most likely outcome is that one more camera will be returned. Vendor 3-4 makes the following adjusting entries: to record expected sales return on January 31, 2019. Sales return and allowance 100 in credit and account payable 100 in debit. To record the expected return of the one camera and related cost of goods sold, estimate inventory returns 60 in credit and cost of goods sold in debit 60. At January 31, 2019, sold in debit 60. At January 31, 2019, vendor records an account payable to recognize its estimate additional liability to Amaya for expected future returns. The estimate inventory returns account will generally be added to the return inventory account at the end of the reporting period to identify returned and estimate inventory return. Illustration present the information related to these sales that will be reported on vendor's income statement for the month of January. Sales revenue €10,000, less sales return and allowance 300, net sales 9,700, cost of goods sold 5,820, and last gross profit 3,880. On vendor's statement of financial position as of January 31, 2019, the information is reported as shown in illustration. Cash or assuming no cash payment to Amaya €10,000, returned inventory or including estimate 1,080, and last account payable 300. Bill and hold arrangement. Question: when should Butler recognize the revenue from this bill and hold arrangement? Solution: when to recognize revenue in a bill and hold arrangement dependent on the circumstance. Butler determines when it has satisfied its performance obligation to transfer a product by evaluating when Barristo obtains control of that product. For Barristo to have obtained control of a product in a bill and hold arrangement, it must meet all of the conditions for change in control plus all of the following criteria. A. The reason for the bill and hold arrangement must be substantive, and B. The product must be identified separately as belonging to Barristo, and C. The product currently must be ready for physical transfer for Barristo, and last D. Butler cannot have the ability to use the product or to direct it to another customer. In this case, assuming that the above criteria were met in the contract, revenue recognition should be permitted at the time the contract is signed. Butler has transferred control to Barristo. That is, Butler has a right to payment for the fair price and legal title has transferred. Butler makes the following entry to record the bill and hold sale and related cost of goods sold. March 1, 2019. Account receivable in credit 450,000, sales revenue in debit 450,000. Cost of goods sold in credit 280,000, and last inventory 280,000.
Here, I will be presentation principal agent relationship. In a principal agent relationship, the principal performance obligation to provide good or performance service for a customer. Question: what are the performance obligations in this situation, and how should revenue be recognized for both the principal and agent? Solution: the principal in the case is a BI, the agent is fly away. flight travel, because BA has the performance obligation to provide air transportation to the customer. Is this the principal flyaway travel facilities? The sale of the airline ticket to the customer in exchange for a fee or commission. Its performance obligation is to arrange for a BI to provide air transportation to the customer. Consignment. A common principal agent relationship involves consignment. In this case, manufacturers or wholesalers delivers goods but return title to the goods until they are sold. This specialized method of marketing certain types of product makes use of an agreement known as a consignment. Under the consignment arrangement, the consignor accepts the risk that the merchandise may not sell and relieves the consignee of the need to commit part of its working capital to inventory. Consignors use a variety of systems and account details to record consignment, but they all share the common goal of postponing the recognition of revenue until it is known that a sale to a third party is accurate. Consignors only recognize commission revenue. Warranties. Question: what are the journal entries that Maverick Company sold make in 2019 related to the sale of the Rollomatic and the assurance and extended warranties? Solution: Maverick makes the following entries in 2019 related to Rollomatic sold with warranties. October 1, 2019, to record the sale of the Rollomatics and the related extended warranties. Cost $6 million plus $18,000, a total of $60,018,000. Credit sales revenue, a total $6 million. Credit unit warranty revenue, a total $18,000. To record the cost of goods sold and reduce the inventory of Rollomatics. Debit cost of goods sold $4 million. Credit inventory $4 million. November 22, 2019, to record the warranty cost incurred. Debit warranty expense $28,000. Credit salaries and wages payable $3,000. Credit inventory $25,000. December 31, 2019, to the record the adjusting entry related to its assurance warranty at the end of the years. Debit warranty expense $44,000 and credit warranty liability $44,000. Refundable upfront fees. Company sometimes receive payment or upfront fees from customer before they deliver a product or perform a service. Upfront payment generally related to the initiation, activation, or setup of a good or service to be provided or performed in the future. In most cases, these upfront payments are non-refundable. Examples include fees paid for membership in a health club or buying club and activation fees for phone, internet. Question: what is the amount of revenue Bigelow Health Club should recognize in the first years? Solution: in this case, the membership fee agreement may be viewed as a single performance obligation. Similar services are provided in all periods. That is, Bigelow is providing a discounted price in the second and third years for the same service, and this should be reflected in the revenue recognition in those.
Okay, thank you for the time being from me. Now I want to presentation my material about presentation and disclosure. Okay, the first I want to tell about presentation. Presentation is a company's use and asset liability approach to recognize revenue. For example, when cereal partner delivers cereal to Carrefour, it has a right to consideration from Carrefour and therefore has a contract asset. If on the other hand, Carrefour performed first by preparing for the cereal partner has a contract liability. Companies must presentation this contract asset and contract liability on their statement of financial position. Okay, contract in presentation. Okay, now I will describe two types presentation. The first contract asset. Contract asset are two types. The one unconditional rights to reserve consideration because the company has certified its performance obligation with a customer, and two conditional rights to receive consideration because the company has staffed one performance obligation but must staff the any more performance obligation in contract before it can bill the customer. Okay, next about contract liability. Contract liability is a company obligation to transfer good or service to a customer for which the company has reserved consideration from the customer. Contract liability is generally referred to as unearned sales revenue, unearned service revenue, or another operate account title. Okay, the next about contract modification. Okay, companies sometimes change the contract terms while it ongoing. This is referred to as a contract modification. When a contract modification occurs, companies determine whether a new contract result or whatever it is a modification of existing contract. Okay, separate performance obligation. A company accounts for a contract modification as a new contract if both of the following conditions are stated. The first, the promise cut or service the distance. Next, the company has the right to receive amount of recording consideration that reflects as standalone selling price of the promised good or service. As disclosed include the closing balance of asset recognition to obtain of fulfill a contract, the amount of amortization recognition, and method of amortization. Okay, now I want to explain a few disclosure type. Okay, the first, the segregation of revenue. A recruitment disclose disaggregate revenue information in categories that they keep how to nature, amount, timing, and uncertainty of revenue and cash flow are affected by economic factor. Reconcile the desired revenue to revenue for a portable statement. The next about reconciliation of contract balance. Disclose opening and closing balance of contract asset and liabilities and profit a quality description of significant change in the amounts. Disclose the amount of revenue recognition in the current period relating to performance obligations that satisfied in a prior period. Disclose the opening and closing balance of trade receivable if not presentation elsewhere. The next about trimming performance obligation. Okay, disclose the amount of the transaction. Okay, now I want to describe about disclosure. Okay, the disclosure recruitment of revenue recognition are designed to help financial statement users understand the nature, amount, timing, and uncertainty of revenue and cash flows arising from contracts with customer. To achieve that object, companies disclose qualitative and quantitative information about the following. The first, contract with customer. These disclose include the disaggregation of revenue, presentation of opening and closing balance in contract asset and contract liabilities, and significant information related to their performance obligation. Next, significant adjustment that discussed include judgments and change in the judgment that affect the determination of the transaction price, the allocation of the transaction price, and the determination of the timing of revenue. The last, asset recognition from costs incurred to fulfill a contract. These disclosures include the closing balance of asset recognition to obtain of fulfill a contract, the amount of amortization recognition, and method of amortization. Okay, now I want to explain a few disclosure type. Okay, the first, the disaggregation of revenue. A recruitment disclose disaggregate revenue information in categories that they keep how to nature, amount, timing, and uncertainty of revenue and cash flow are affected by economic factor. Reconcile the desired revenue to revenue for a portable statement. The next about reconciliation of contract balance. Disclose opening and closing balance of contract asset and liabilities and profit a quality description of significant change in the amounts. Disclose the amount of revenue recognition in the current period relating to performance obligations that satisfied in a prior period. Disclose the opening and closing balance of trade receivable if not presentation elsewhere. The next about trimming performance obligation. Okay, disclose the amount of the transaction price allowed to remaining performance obligation not subject not significant revenue reversal. Provide a narrative discussion of potential additional revenue in a constrained arrangement. The next, costs to obtain or fulfill contract. Disclose the closing balance of capitalist cost to obtain and fulfill a contract and amount amortization in period. Disclose the method used to determine amortization for each reporting period. The next about other qualitative disclosure. Disclose significant adjustment and change in judgment that affect the amount and time revenue from contracts will customer disclose how management determines the minimum amount and revenue not subject to the variable consideration contract. Thank you.